All right, and we're going to start the webinar. Attendees should start coming in here in a moment. All righty, and you guys are live.
Perfect.
Good luck.
Okay. Hello and welcome to the last session of the Association for Evolutionary Economics. And the topic today is monetary policy, financial stability, and institutional issues. We have 5 very different papers that covers topics in banking, central banking, financial markets in a range of countries and regions. So Zambia, UK, Japan, and Latin America. They all deal with contemporary institutional issues in finance, ranging from financial benchmarks and the activities of megabanks to quantitative easing and sustainability. Each presentation will be around 15 to 18 minutes, which means that we will be done in about 90 minutes. After that, we'll have a 30-minute Q&A and discussion. So please use the Q&A button to ask questions throughout the sessions, and I will then monitor that towards the end of the session. So welcome everybody, and without further ado, let me introduce the first speaker, who is Lilian Muchimba from the University of Portsmouth.
Thank you for this opportunity to present. I'm presenting a paper on Beyond LIBOR, Money Markets and the Illusion of Representativeness. It's co-authored by Alexis, Stenfors, and myself. So I'll provide the context of the research, provide the theory and definition, the rationale and contribution. I'll describe the data and approach, discuss the findings and the implications of the research. So money market benchmarks are also commonly known as interbank offered rates. These are critical for our economy. They act as reference rates and facilitate risk management through pricing of floating rate loans, mortgages, and derivatives. They also enable us to measure investment performance and funding costs. Central banks also use money market benchmarks to monitor the interest rate channel of the monetary transmission mechanism. The monetary transmission mechanism has been institutionalized in a number of economies, especially inflation targeting economies. Most IBORs are based on unsecured money markets. So for example, we have the LIBOR, the Euribor, and the TIBOR, with the LIBOR being the most widely used financial market benchmark and approximately 400 trillion US dollars of financial contracts underpinned by LIBOR. So IBORs and similar benchmarks are judgment-based. So on a daily basis, banks submit the rates at which they think they can access funds in the unsecured money markets. And this provided incentives for banks to manipulate their submissions. So banks manipulated their submissions in order to benefit from their large derivative positions and to signal their credit worthiness. To this effect, LIBOR was deemed unrepresentative and it's expected to cease by end of this year. Financial market regulators have recommended a shift towards alternatives, which need to meet the attributes of a good benchmark. So IOSCO has recommended attributes of a good benchmark, and these include representation, reliability, robustness and resilience, transparency. So while these others are important, we have representation as arguably the most fundamental. And this entails that a representative financial market benchmark should be anchored on actual transactions. So to achieve representativeness, financial market regulators have recommended paradigm shift from using estimation-based estimates to transaction-based estimates. So transaction-based estimates entail that financial market benchmarks should be based on actual transactions in the underlying market. So for example, we have the United States selecting the secured overnight financing rate as an alternative, and the United Kingdom selecting the sterling overnight index average as the alternative. The paradigm shift is based on the conventional money market understanding. We have authorities in economics and finance define the money market according to the maturity. So for example, we have Friedrich Mishkin, who's a professor in economics and a former board member of the Federal Reserve, define the money market as a financial market in which short-term debt instruments with the original maturity of 1 year or less were traded. And we also have another authority, Frank Fabosi, who's also a professor in finance, in his handbook of fixed income securities, which is a handbook which is found in a number of trading floors across the world, define the money market as a place where debt obligations of a maturity or 1 year or less are traded. So basically we see that the conventional understanding of the money market being defined as in terms of maturity. So money market benchmarks to this effect have been perceived as a unit representative of the whole money market. Problematically, money markets have limited empirical assessments. This is because we only have general information in these markets publicly available. This is because money markets are over-the-counter markets and there are confidentiality issues regarding the data. Fortunately, this data has unique transaction level data from Bank of Zambia. And this paper uses this unique data to eliminate the specificities of money markets and to contribute to the theoretical understanding of money markets. In terms of the approach to eliminate the specificities of the unsecured money markets, the study uses the traditional metrics such as the number of trades and turnover, as well as the percentage of time trades are actually observed in the market. And to contribute to the theoretical understanding of representation, this study employs the institutional approach and draws insights from Veblen, Keynes, Stenfors, and Lindo. So the data used is from Bank of Zambia, and it constitutes every single domestic interbank transaction from April 2012 to December 2020. And it includes trading volumes, interest rates, counterparties, and type of collateral. So we collected this data from Bank of Zambia as it is not publicly available. In terms of the findings, if you look at figure 1 there, we show the cumulative turnover in the Zambian unsecured interbank money market in millions of kwacha. What you can see is that there's concentration of activity in the 1 to 7 days maturity bucket. You see a bit of growth from 2012 to 2019, but this just represents doubling of about 1.5 billion US dollars. So it hasn't really grown in the dollar terms. So when we look at the total number of trades per maturity category, we actually see that we observe the same picture. We note the concentration of activity in the 1 to 7 days maturity bucket. And we have the highest number of trades recorded in 2016 with about 922 trades, and the lowest number of trades recorded in 2018 with about 356 trades. So when we look at the days with observed trading activity in percentage, in figure 3 there shows concentration of activity in the 1 to 7 days maturity bucket. And you notice that the other maturity buckets, there's barely activity in the other maturity categories. So to summarize this, we've seen that the money market is made up of 2 distinct markets. We have the ultra short term, 1 to 7 days, and this is typically overnight, and the term money market, which is beyond 7 days. In the ultra short-term segment, we noticed that that's where most of the activity is actually concentrated. We have over 90% of cumulative turnover, over 90% share of trades, and over 95% observed trading activity in this market segment. So this market segment is large, liquid, and has regular activity. On the other hand, the term money market has limited activity. We have less than 2% cumulative turnover, 0.1 trades, 0.1% share of trades beyond 31 days, and trades in the 91 to 365 days were only reported in 2018. Further, we can see that there's less than 5% observed activity in this maturity category. So the term money market is small, illiquid, and has irregular activity. So as you've seen from the results, Zambia is a minuscule compared to the other advanced markets, but we have similarities. So if we look at this ECB data in 2020, it showed that the one-day maturity segment accounted for 98% of the turnover, with only around 1% turnover taking place in the maturities beyond overnight. And when we look at the Bank of England data as well, it showed that transaction-based submissions in the 3-month LIBOR dropped to 0. So basically, the submissions were not based on any underlying transactions in the early days of the COVID pandemic. And we had 50% of the published, 35 published LIBOR rates across the currencies, which were not actually based on underlying transactions. So further, when we constructed the framework from the institutional lens, it revealed that the evolution of the money market actually started before the 2007-2008 financial crisis. And we had historical factors contribute to the evolution of this market. For example, we had the Basel Code in 1988, which led to the growth of off-balance sheet items, such as derivatives, and discouraged the growth of on-balance sheet items, for example, the euro dollar market. So the authoritative beings in finance have influenced the habits of thoughts in the money markets, and these have been passed from generation to generation. So despite the evolution, institutions do not reflect the existing conditions in the money market. It seems that if we look at performativity in terms of the institutional lens, the money market definition has actually performed this illusion that we have one representative money market. So the definition has become distant from what it intends to represent. So to this effect, the generalizations that have been made in the money market have only reinforced this illusion. So this case is similar to how the evolution of derivatives created the illusion that the money market benchmarks and money markets are synonymous. It's also similar to a case of how the conventional usage of quantitative metrics overestimated the competitiveness and liquidity in foreign exchange markets. And it's also similar to how the prominent application of mathematical equations suppress the questioning of the underlying assumptions. The details are in those papers there. So in terms of the implications already, what can we say will happen beyond LIBOR? Already, we can see that there will be a shift to a new norm. Jurisdictions are already shifting towards transaction-based benchmarks, as I've already highlighted. But most importantly, however, evidence points to a distinction between the ultra short-term money market and the term money market. So this means that representation can only be achieved in the ultra short-term money market and not in the term money market. And this disconnect between activity in the two markets raises questions in terms of how central banks can actually assess the effectiveness of the interest rate channel monetary transmission mechanisms. This is the case especially for countries like Zambia, which are even less liquid. So to replicate the term LIBOR, mathematical methods have been underway, but however useful, these will only reinforce the illusion of representation. Thank you.
Thank you very much, Lilian. On time and with actually minutes to spare. So that's a good start. I think the Q&A function and chat function should work right now. Or if somebody else, Tanweer, do you think it's working? Sorry if
I believe it is working.
Yeah. But so you can use that to ask questions. Please use the Q&A if possible. But without further ado, let's move on to the next speaker, which is you, Tanweer.
Yes, thank you very much. I will share my screen and let me know when you can see my screen. Can you see? You should be able to see my screen now. And, okay.
Perfect.
Right.
Yeah.
I'm going to talk about the empirics of UK yields. This is joint work with Huiqing Li from the Central University of Finance and Economics. This is a working paper, so I will concentrate on the describing our paper qualitatively rather than going into the detailed the econometric work of this. So let me start with one of the highlights and then elaborate on this. So in this paper, my co-author and I analyzed the yields of UK gilts using quarterly data to model nominal yields. We take a Keynesian perspective on modeling government bond yields, and Keynes argued that the short-term interest rate has a crucial influence on long-term bond yields, and that's what we find. We also show that higher government debt ratio does not lead to higher bond yields. We use a vector error correction VAR model as adapted to vector error correction representation to model this. So that's what the paper does, and rest of the time I'm going to just elaborate on these points and go show some features of the model that we develop in the paper. What I will discuss is the research question and motivation, Keynes's view on long-term interest rate, look at the data sources, and look at some unit truth tests, or describe the unit truth test, how we went about the model estimation and the key findings, and conclude there. So the questions that we ask are: what factors drive UK gilts yield? Does the short-term interest rate influence yields? What else matters? What is specifically, what is the effect of debt ratio as a share of GDP on yields, bond yields? And this presentation is an empirical analysis of UK bond yields. So let's start with Keynes's view and the empirical literature, and contrast this with the conventional view. The conventional view on government bond yield is based on a loanable funds view. It holds that the government bond depends on the demand and supply of funds in the capital market, and also specifically an increase or a decrease in debt or deficit ratio can lead to higher bond yields. There's a substantial literature on this, both in empirical literature as well as theoretical literature from the mainstream point of view. In contrast, Keynes, in his treatise, argued that to quote, the influence of the short-term rate on interest rate is much greater than anyone would have expected. He drew this view based on empirical work that Reifler had conducted in the 1930s. In Reifler's study said the surprising fact is that long-term bond yields are relatively stable in comparison to short-term interest rates, but they have reflected fluctuations in short-term interest rates so strikingly and to a considerable extent. So, Reifler did some empirical work, and Keynes kind of generalized this both in his treatise on money, and that carried over into the general theory. Keynes, of course, had a very considered view on interest rates driven by psychological and sociological factor. And myself and my co-authors have tried to take that view and try to empirically model this from a Keynesian point of view. So let's just look at the data, some stylized facts before we share the results. Let's see. So this is the evolution of bond deals in sorry, I'm not sure what is happening. Let me go back. Sorry about that. My computer has frozen. So my apologies for this. Okay, I will just give me a second. I'll switch to the PDF. This is the evolution of bond yields in the UK. So next we look at the evolution of short-term policy rates and short-term interest rates. The short-term interest rate very much, and this is just a scatter plot of short-term interest rates, the levels of the short-term interest rates, and the level of 5-year bond yields. And there is a pretty strong correlation. If we look at the changes year-over-year, change in bond yields, bills, interest rate bills, and the change in bond yields, percentage point change. There's also a positive correlation, not as strong, but it definitely exists. If we look at the evolution of inflation and bond yields, we see that there appears to be a connection, although not as tight. Most of the time, historically, bond yields are higher than CPI or RPI inflation, but not always. If you look at this period over here, the relationship becomes less strong. Nominal yields can be often less than CPI, particularly after 2010. This is the evolution of fiscal ratios in the UK. The data that we use for the paper is a variety of data: short-term interest rates, long-term interest rates across the yield curve. We will, for the econometric results, we look at 5-year and 10-year. That's what we show, but we have done across the yield curve, and the analysis goes through irrespective of what maturity tenures they use. For inflation, we use total CPI as well as retail price index, all items exclude, but we can also do the same with other measures of inflation. For economic activity, we use industrial production. For fiscal indicator, government debt ratio, and the time period that we cover is from 1990 to 2018. And the sources are from Macrobond and US Office of National Statistics. Going over the model, what we do in the model, we start with model specification, model estimation, starting with unit root test, multivariate co-integration test, testing for structural breaks. Then we construct a vector error correction model, and we provide some interpretation of the results, and we conduct some stability tests. I won't I won't inflict too much econometrics on you. So I'll just, I actually know econometrics. I'll just summarize the results and then to look at the policy implications. Summary of the findings are as follows. The unit truth test showed that that long-term interest rates, the short-term interest rates government debt ratio are non-stationary in their levels, while inflation and growth of industrial production are stationary in their levels. The first difference of all the variables are stationary. It should be 9. We construct 9 different VAR models are defined to analyze co-integration. There is no co-integration in some of these models. However, the problem is that in presence of structural break, standard co-integration could be biased. So we, to address the potential for structural breaks, we use Gregory-Hansen co-integration test rather than standard tests. The results of these Gregory and Hansen co-integration tests reject the null hypothesis of no co-integration. And then we also use Chow test to reject the null hypothesis of no structural breaks. Then we find, co-integration, and this is just the example of the co-integration result, just one of the examples that we find. Stability tests show the stability of the coefficients. Looking at the implications, now going over quickly at the implications of the findings. The implications are the BOE, the Bank of England influences nominal yield and the shape of the treasury yield curve, mainly through the effect of the policy rate, and from that to the short-term interest rates, which in turn affect long-term interest rates. Higher debt ratios is not associated by higher yields on gilts. There's ample scope for our activists, which we take to suggest that there's ample scope for activist policy. The findings are germane to ongoing debates in policy, as well as macroeconomic theory and macrofinance. And this evidence raises doubts about the merits of austerity policies with countries such as the UK with sovereign currency. So to conclude, what I would say is that our findings show that BOE's action on the policy rate and other monetary policy actions, which some of which is not captured in our model, have a decisive effect on yields, bond yields. The empirical analysis for yield holds for various maturity tenures. Our findings suggest that Keynes's views on central bank policy actions have a decisive influence on long-term interest rates through the short-term interest rate. This is well supported, and this is relevant for discussion, the empirical finding for the UK, and supported also by similar findings that myself and others have shown and found for other countries. Let me stop there. I think I'm good on time and happy. I think Q&A is at the very end, right?
Fantastic. Thank you very much, Tanweer, for good paper, interesting presentation. Next in line is Mimoza Shabani from the University of East London, who will talk about Latin America.
Yes, I will. Hi, I'll share my screen, Alexis, and I'll make sure that everything's good. Can you all see my screen?
Not yet. No. Now we can.
Okay.
Perfect.
Hi. Okay. So we have 15 minutes, right? So no pressure.
15 to 18 minutes. Okay.
Well, good evening, good afternoon, everyone. Greetings from Albania, where I'm currently stranded. I cannot go back to the UK, so it's relatively late here. I'm going to start off by just highlighting a small change in the title of my presentation. Originally, it's carry trade activities of mega banks in Latin America. I'm looking at multinational banks, and I will give the reasons as to why I've changed this, but just to give a hint of a slight change here. Okay, so the activities of multinational banks in Latin America, where they've been very active since the 1990s, it's well documented in the literature. One of the highlights that the literature provides is that these foreign bank institutions that operate in these countries, they are the key providers of credit in the host economies. So there's been a lot of studies in terms of their impact of transmitting shocks on providing credit and the implications on the domestic economy and so forth. And another aspect that has been thoroughly analyzed in the literature is the use of the internal capital market by these banks, whereby the parent bank provide the liquidity for which the foreign institutions are able to provide the credit necessary in the host economies. Again, this is in itself an interesting topic to analyze in terms of the impact both host and home economies. But nevertheless, I just want to highlight that this channel is very, very important for liquidity transmission between the multinational banks. Now, on the other hand, what I've been thinking about is that this the liquidity or the credit provision of parent banks to their foreign affiliates could be motivated by these driven by carry trade motives. Of course, then this is so, or these activities and the usage of the internal capital market poses important implications for both. It hinder domestic monetary policy, and then it poses implications for financial stability, especially given the high volatility associated with the major currencies in the Latin American countries. I'm also going to hint a little bit and discuss about the issues of this in the current pandemic. When I put this thoughts together for this presentation, the pandemic was not so much, but now it's something that we cannot avoid. Okay, so there's been a lot of discussion that Latin American countries have been the target to carry trade activities, especially in the post-2008-2009 financial crisis. I mean, the key motivation there is the interest rate differential, of course, is the driving force behind the carry trade. But the region, Latin America, they offer high interest rate, relatively high interest rate. I mean, Argentina has the highest interest rate in the world. It went from, I think I have a graph, from 26% to something 60%, the key interest rate. So, of course, you know, these high interest rates are the driving motive of the carry trade activities of banks. Now, multinational banks could indeed play a key role in these carry trade activities. There are different ways, you know, these activities can be conducted, but what I'm trying to view this of where I focus is the acquisition of domestic assets via the foreign subsidiaries. When I say domestic assets, the domestic assets in Latin America. Another point that I want to highlight here, what our focus is on the US dollar, is purely because of the data limitations. So I know that in Latin America, there are banks operate in there, you know, we have a lot of European banks, as well as US banks, Canadian banks. But for the carry trade analysis, I'm focusing on the US dollar, and that will become evident as to, you know, what I'm saying. Okay, just so the background, why has this carry trade argument has been highlighted by many lately. It's exactly this. If we look at the key interest rate and the interest rate set by the monetary policy of each country, it's in Argentina, Brazil, Chile, Colombia, Mexico, and Peru, and these are the countries that I focus on my analysis. We can see that this is it's really, really high. Apart from Argentina, like I mentioned, it's really, really it's the largest in the world. The other countries, they have interest rates, which they are well below 10%, with the exception, I think, of Peru, which is around 2%. But nevertheless, as of 2019 and 2018 and 19, they've fallen as well. In comparison to the interest rate of select G10 countries, so Canada, Switzerland, United Kingdom, Japan, US, and the Euro area, we can see that interest rates here are really, really low, as we all know, as you know, especially with the economic activity that's been taking place. So right there, we can see that there is an interest rate, made a big difference in the interest rate differential between the Latin American countries and say G10 countries. Now, to actually have a look at what's all the activities of these multinational banks, I obtained data from Bank Focus, previously known as BankScope, of all of the foreign banks that operate in 6 countries in Latin America, and that's Mexico, Argentina, Brazil, Chile, and Colombia, and Peru. Now, I take a sample of their domestic banks as well as the foreign banks, foreign affiliates. I only take into account including the sample, the foreign subsidiaries, which they are at least 50% owned by the parent bank. So I need that this in order to make to link the internal capital market argument there, but whereby they provide funds to one another. Okay, so I end up with a total of 103 foreign-owned banks and 129 domestic banks in my sample. Now, when I looked at the data from BankScope and the banks that operate, I thought it's best to include my original idea of the definition of the mega banks, as I originally put in the title, was these highly important institutions. And I didn't want to focus just on that, because even smaller, not so important financial systemic institutions, they're key providers of credit in this economy. So that's why I changed it from mega banks to multinational, relatively large size banks, but not just to focus on the largest banks. Okay, so this is the data that I get. So to have a look at the foreign bank participation in these 6 Latin American countries, Mexico is the top. 70% of the total banking assets is owned by foreign bank institutions, and that is followed by Peru. The least foreign bank participation is Brazil, which is is less than 20% by asset size. Now, this table has so much information, and I really have no time to, but what I'm going to try and highlight the key findings to bring about the key activities of what these banks do. And I'm trying to compare the domestic banks and foreign banks. But very briefly, if I look at the foreign banks in Brazil, and look at the loan to deposit ratio, we see this, but that's relatively high here. So, they do rely they don't rely so much on deposits to provide credit, but they've been relying more recently on wholesale funding. As we've seen, the ratio has gone from 0.17 in 2013 to 0.32. So there's nearly more than double in 2019. That's not the same case for Mexico. If we see the foreign banks in Mexico, we can observe that they rely less on deposit to provide credit, but they also rely less on wholesale funding to provide credit in the economy. I mean, this is the first hint that they could indeed receive funds from their parent banks. Okay, so if they're reducing the reliance on both deposits and wholesale funding, then it could be true that indeed, they receive funds. In Argentina, on the other, the loan to deposit ratio has slightly decreased from 2013, and wholesale funding has also decreased. Now, in terms of profitability in Brazil has fallen significantly from 2013 to 2019. It has increased in Mexico, and it has increased in Argentina. In Chile, the profitability has been rather stable, and Peru as well. Now, moving on to have a look at how much credit these banks actually do provide in the economy. Well, I'm going to just focus on the total loans as a percentage of the total loans that the foreign banks provide as a percentage of the total loans in the economy. So we'll see in Mexico, nearly 70% of the credit of the loans provided in the economy, it's conducted by foreign banks in this country. That's less in Argentina, but so much more in Peru. It's nearly 65, more than 65% of the loans is conducted by, it's provided by foreign banks operating in Peru, and 34% in Chile. It's worth noting here that the corporate loans, it's more than 84% of corporate loans in Mexico. It's provided by the foreign institutions that they operate in Mexico. So it's just, it really highlights the importance of these foreign institutions in providing the credit to the host economies. I don't know how much I'm doing with time, but I've got some macroeconomic indicators here that I'm going to focus on the FDI inflows and greenfield investment in Argentina, reflecting the economic conditions in 2018 and 19. FDI inflows have decreased significantly, as well as greenfield investment. In Brazil, they have actually increased both the inflows and greenfield investment, and Chile, they have also, FDI inflows have decreased, and as well as greenfield investment. Whereas in Mexico, FDI inflows have also decreased, as well as greenfield investment has decreased. Following the recession that the country experienced in 2019. Okay, so this was just an overview of some of their activities and their role that they play in the economy. Now,
Mimoza, about 3, 4, 5 minutes left.
Bloomberg offers a carry trade index. Sorry. So this is where my paper actually starts. Okay, so as can be seen, the blue line here is the Latin America Carry Trade Index provided by Bloomberg. Okay, so it shows that the return from these carry trade activities, it's higher than in carry trade, especially post 2008, and this is annual data. And I'll come back to that. Why this? I put an emphasis on the frequency of the data. What I've been thinking about is this dividend payment of these foreign institutions to their parents' banks. We're assuming that we have this internal capital market whereby they receive funds from the parent banks. Then they also repatriate their profits or their earnings in these host economies to their parents' companies. And this is what I've gathered from Mexico. It's at the top, followed by Brazil. These two countries dominate in terms of, out of the 6 countries, in terms of where they provide more dividends to their parent, to the shareholders of their parent bank, basically. Now, if I were to have a look at the correlation between this dividend payments and the carry trade index that I've just shown, for Mexico, Colombia, and Brazil, this correlation is quite high. They're somehow correlated. So the higher the carry trade index, and the higher these dividend payments back to their parents' company, which, I don't know, it could very well hint that there is something working in this internal capital market. Okay, so we have some literature that the carry trade opportunities, the profit being made in Latin American countries does exist, but and it's been evident there. But I very briefly, I don't know how much time I've got, but I could not fail to mention the recent event of what's happening, because like I said, I've been looking up to 2019 and trying to figure out whether this internal carry trade channel does indeed exist. But whatever's been happening up to 2019 has just changed. The outlook has changed with the pandemic. And this is perhaps where the most, you know, the vulnerability of these activities could you know, it exists. Because the pandemic has caused major losses for emerging markets carry trade activities. And it's been cited that the losses amount to a decade's worth of return for emerging markets. Okay, so this is huge losses. Remember, the carry trade activities, it's profitable when the volatility is very low, but what we've seen in the emerging markets, the volatility is really, really high. So this poses a great financial instability. It's a threat to financial stability, basically. Now, Brazilian real and Chilean peso have fallen significantly in the aftermath of the pandemic. However, Mexico still offers relatively high inflation adjusted. This is as of summer 2020. Now, this is a monthly, the same index as I showed in the app for the annual data. This is for the monthly data, because it could perhaps show what's been happening in the pandemic, since the pandemic. Like, we've seen so far that the Latin America Carry Trade Index offers a higher return than the G10 country. But as we've seen, I've got data here until November 2020, so not long ago. And we've seen that, yes, it did go down. The carry trade index did go down, but then it has increased slightly, and it's again above the G10 index. So the carry trade opportunities still could be there, and for investors to it offers some conclusions. Well, it seems that there is a profitable opportunity in the carry trade in a number of Latin America countries.
Mimoza, you're on mute.
Oh, sorry, I don't know how I did that. I really don't know how. Okay, so it seems that that there exists an opportunity in the carry trade in the Latin American countries. Of course, the internal capital market could be a source of channeling liquidity to exploit these carry trade opportunities. And I've already briefly mentioned that there is a positive correlation between dividend repatriation and carry trade index. And I'm going to end with the implications of the current pandemic. I mean, 2020 will be the biggest stress test for banks, and the outlook certainly looks uncertain. Thank you very much.
Fantastic. Thank you. I certainly have many questions. Hopefully we have time for them in an hour or so, or half an hour. Okay. Now, next up is Professor Jan Toporowski from SOAS, who will talk about Japan.
Yeah, Mimoza, if you could get rid of your, if I could take the screen from you, or should I just take it anyway?
Are you? Yes, can you? I've stopped sharing. Okay.
Okay.
Perfect.
You can see my wonderful. I've got it all up now with the indicator showing precisely how much time I'm using. So, as well as the next screen. So I'm actually I can see what I'm talking about, or what I'm trying to aim for. My this paper, I apologize, it's been very much thrown together at the last minute. I wasn't able to do as much of the empirical work as I wanted to do for various reasons that were beyond my control, as so much is these days. But I'm going to talk about the policy of yield curve control and its how it was applied, how it has been applied in Japan. It's worthwhile reflecting on this because we've now there's been a change of prime minister in Japan, and there's every possibility that this is that this may result in a review of the kind of monetary policy that's being conducted. I'm going to go along with, or actually, I'll develop further something that Tanweer was talking about, which is Keynes's and Kalecki's views of the yield curve and the connection between that and monetary policy. I will say something about the neoclassical moment. This was the point at which the ideas about the yield curve become neoclassical in the sense of supposedly determined by an implicit general equilibrium, and how monetary policy is supposed to affect that. Then I will say something about the yield curve control that was implemented, or that has been implemented in Japan, and how this is essentially a neo-Vixelian idea, or the conception behind it is neo-Vixelian, rather than one rooted in the institutional the financial institutions within which monetary policy operates. And therefore, I'll conclude by saying something about the institutional setting for yield curve control. Okay, we start off with Keynes's and Kalecki's view of the yield curve. Both of them regarded the long-term rate of interest, in other words, the yield on long-term securities, as the rate of interest that is relevant to business investment and is therefore crucial for economic growth, for the level of employment, the level of output, and so on. Why was this long-term rate of interest more relevant than the short-term rate of interest? Well, it's because it's because of funding. It's because of this idea that investments may be undertaken using internal funds or money borrowed from the bank, but eventually the cost of those investments will be funded. In other words, a long-term security will be issued to repay the bank borrowing, to top up the internal reserves of the company. And this therefore makes the long-term rate of interest is essentially the eventual financing cost and the opportunity cost of long-term capital investments. This is, and certainly in their time, this was in contrast to the theory that Wicksell had put forward, which is that the real or the natural rate, it's the difference between the real or the natural rate, the real or natural rate being the profit on investment. If you deduct from this real or natural rate of interest the money rate of interest, if it's positive, then there will be then investment will take place. If it's negative, in other words, if the profit on investment is below the money rate of interest, then this will discourage investment, and in fact there will be disinvestment. Now similar to this, similar to Wicksel's view, was the view of Hawtrey. I mean, Hawtrey was Keynes's rival. He was the man who wrote the Treasury view, which poo-pooed Keynes's idea of ideas on fiscal stimulus. Hawtrey had this idea that the money rate of interest is the rate of interest that's relevant not so much to investment, but it's the rate of interest that's relevant to retail or wholesale stocks, because when merchants or retailers or wholesalers finance their stocks, they finance their stocks using short-term borrowing, and therefore if the short-term rate of interest goes too high, then they will run down their stocks, and they will and they won't make orders, and it's the orders of retailers and wholesalers that determines the business investment, which according to Hawtrey correctly, business investment is largely internally financed from the internal resources of a company, of companies. Okay, let's debt management. Debt management comes into this because both Keynes and Kalecki argued that you need open market operations to control long-term interest rates, and certainly in the 1940s, during in all their discussions on war finance, which gave rise to huge ballooning government debt in Britain, went up to something like over 200% of GDP. The open market operations were needed to control the rate of interest at which the government borrowed. And you find in both Keynes's writings, and intriguingly also in Kalecki, in the most unexpected place, a description of what's come to be called Operation Twist, in which to control long-term rates, in which in effect the government issues short-term bills and uses the proceeds to buy long-term bonds, effectively forcing the price of long-term bonds up, and a decline in long-term yields, and this, of course, then allows the government to issue long-term bonds to pay back the original what was then called floating debt or treasury bills. They both of them laid emphasis on the idea of using long-term bonds, or at least Kalecki, because Kalecki in particular recognized that if you have high levels of government expenditure, this tends to be concentrated in business profits and can give rise to excess liquidity. So within the banking system and in corporate structures. So you need to issue longer term bonds in order to, as if, immobilize that excess liquidity, tie it down in bonds, so it doesn't actually go into the into circulation. With post-war debt management, you had the Radcliffe report recommending open market operations to control long-term rates of interest. A recommendation, incidentally, that was largely ignored. And I recently came across this book by Bill Allen on the UK gilts market. Very interesting reference to the fact that when they, when a conference was organized to commemorate the centenary of the Radcliffe Report in 1969, Michael Brian Tew actually wrote in and complained that they were talking about monetary control, they were talking about control of short-term rates of interest, but no one was talking about the control of long-term rates. And that was Keynes's point and Kalecki's point. Problem with the Keynesian theory is that the long-term rate of interest is relatively stable, certainly relative to the short-term rate. And this was, after Keynes published his general theory, there's a whole shoal of monetary economists, Hawtrey, Hicks, Shackle, and Kalecki, did various studies and showed that the long-term rate of interest actually is relatively stable. And the conclusion that they drew from this is that, therefore, it is a weak causal factor in the business cycle. And then, of course, the discussion got taken over by Hicks's pure expectations theory. I'm hurrying along now to finish off this. And then, Tobin came in with his general equilibrium model, liquidity preference behavior towards risk, where in effect the equilibrium is determined when the return on assets generates a general equilibrium of supply and demand for different assets, including the Q, which is the famous Q ratio. And as Victoria Chick criticized, the real problem there is that in Tobin, he confuses risk for uncertainty, and this is where actually the discussion goes really quite neoclassical. Tobin, however, wrote in 1963. He was commissioned to write an essay on debt management, in which for the first time he pointed out that you cannot distinguish monetary policy from debt management because of the impact that buying and selling government debt has on monetary aggregates, and that therefore the Federal Reserve it cannot be independent of the Treasury. And this is actually quite an important essay. Let me now move on to the Japanese yield curve control policy. This was introduced in September 2016, really following the weak results of the straightforward lowering of short-term interest rates. It was an attempt to flatten the yield curve which had been made steeper by negative interest rates. And here we are, I'll show you from this 2016. Well, if you look at the light blue line, that was the yield curve in 2012, and by the summer of 2016, the yield curve at all maturities up to 20 years, up to nearly 20 years, was negative. In effect, it had been pushed down. In 2019, sorry, this is it is a recent, a much more recent. You can see the effect of this yield curve control policy. It has actually been to flatten, not just flatten, but actually make the yield curve go inversely before steeply rising after the 7-year maturity. This is a policy which I argue is neo-Vixelian, because essentially it aims at price stabilization. If you look at the probably the most significant exposition of this by a high up figure in the Bank of Japan, Mr. Amamiya, he argued that yield curve control is really for use in crisis. If you use yield curve control in normal times, then this is what he calls financial repression, and therefore not to be considered. If you allow, otherwise, if you use it in crisis, then it should aim at price stabilization. In actual fact, what it does is it squeezes long-term investment institutions, pension funds and insurance companies. And in an open economy, leads to capital outflows. So my conclusion, therefore, is that the institutional setting, see, in effect, the Bank of Japan sees the yield curve control as being part of monetary policy, as when the short-term rate of interest is ineffective. I want to argue that actually it's yield curve control goes beyond the scope of monetary policy. It goes beyond merely setting the short-term rate of interest or setting changes in the monetary aggregates. And in fact, the yield curve cannot be disconnected from debt management. So in a high debt economy, which is the case in Japan, and actually after COVID, every economy, debt management is the key link between fiscal and monetary policy. And it's this that transfers money. It's debt management, which debt finance government expenditure transfers money from financial to industrial circulation. Debt repayment transfers money from industrial to financial circulation. And it's the operations along the yield curve that regulate interest rates of different maturities. And these operations have to be done on a permanent basis, and not just, as argued by the Bank of Japan, on a temporary basis. Thank you very much.
Thank you very much, Jan, for this presentation. So the final paper is by Uli from SOAS and Simon from LSE and others. We are actually a little bit ahead of schedule, so there's no reason to rush.
Oh. Okay, great. Yes, thank you very much. Yes, so Ulrich Volz and I will present this paper that is asking the question of how green is the Bank of Japan's quantitative easing policy. And this is, as you mentioned, this is a joint project with Hugues Chenet at UCL and Jusen Asuka from Tohoku University. And this is still very much a work in progress, but we would like to present and discuss our framework and first findings here. Yes, so I will briefly introduce you to the topic at hand and the Bank of Japan's balance sheet, and then Uli will take over and provide an overview of our first empirical findings and some conclusions. Yes. Yes, so in the last year, central banks have begun to acknowledge the implications of climate change for their own policies and operations. So this is a huge debate, and the FT ran a very nice article 2 days ago predicting the ECB to become the next climate change pioneer, which really shows how far we have come in this debate in the last years. An important starting point was the establishment of central banks and supervisors network for greening the financial system in December 2017. And at the time, I think 8 central banks created this NGFS network that aims to share experience among central banks and supervisors on how to best respond to climate change and the threats it poses to macroeconomic and specifically financial stability. And following the Japanese Financial Services Authority, which joined in I think mid-2018, the Bank of Japan then joined in the NGFS in November 2019, and thereby officially acknowledged the need to address climate change in its own policies. At least this is how we observed, how we interpreted this. And yes, so recently in Japan, the discussions have intensified regarding the materiality of climate-related financial risks and the need for monetary and financial authorities to align their policies and operations with these sustainability goals. Yes, so with this NGFS membership, the BOJ has become very much part of this ongoing debate about the nature and magnitude of the implications of climate change for financial stability risks. And yes, so on the risk side, there is already a growing consensus regarding the role of central banks in addressing climate change and related risks. So this is more or less well accepted or increasingly accepted by central banks. But on the monetary policy side, views differ regarding the implications of climate change for monetary policy frameworks, targets, or also specific instruments then. And the big questions in this monetary context are here on this slide. First, what are the implications of climate change for price stability and monetary policy? This is the starting point. This is what most central banks can agree on, that this is an important issue to assess. But then secondly, the question is, should monetary policy instruments be market neutral or take climate impacts into account? And this second question is particularly relevant in the context of asset purchase programs. For example, the ECB based its corporate asset purchase program on a particular understanding of the market neutrality principle. And this has different implications, and the question is what means market neutrality here. So the Bank of Japan has put considerable effort into implementing unconventional monetary policy with the aim of reflating the Japanese economy and achieving its 2% inflation objective. So enormous use of unconventional monetary policy, and therefore also very urgently or very importantly, the question of what the climate impact is here. Yes, so here we have an overview of the Bank of Japan's balance sheet as of last December. And on the asset side, the amount of government bonds held is of course significant, as we all know, making up 76.5% of total assets, or 543 trillion yen. But we are especially interested in corporate bonds, which amount to only 1% of total assets and around 6.4 trillion yen. And then ETFs, which amount to almost 5% of the portfolio. So ETF purchases by the Bank of Japan. Yes, so these 35.2 trillion of index-linked exchange traded funds provide basically the starting point for our analysis. And the BOJ's ETF purchases started around 2010 and accelerated later as part of the stimulus measures under Governor Kuroda. And the BOJ this has led the BOJ to become the largest stockholder of several companies, and also now the biggest owner of the nation's stocks. And holdings have been growing constantly since 2010, but quicker since March 2020. It seems this has also been a crisis response instrument used by the BOJ. Also of interest to us, but much less important, are these 6.4 trillion of corporate bonds that the BOJ is holding. And these purchases seem to also have served the BOJ as a crisis response instrument in the last 9 months. And they have doubled since March 2020. Yes, so this slide just serves to show this. The figures show the development of these purchases over the last 2 years. On the left, we see the development of corporate bonds and ETFs. Both increased since March, increasingly. And then on the right, we see the development of government bond holdings in orange, and then total assets in green. And government securities purchases have also increased strongly since March. Yes, so this brings us to our fundamental research question, which is, what is the environmental impact of the asset purchases by the Bank of Japan? And the motivation for this, or the reason why we're asking this question is, well, first, the analysis of asset purchase programs of the Bank of England and the European central banks have shown a heavy carbon bias. And then no such analysis exists to date for the BOJ. And against this backdrop, the paper investigates what can be said about the BOJ's monetary policy in terms of climate or carbon intensive sector exposure. Yes, so this question has already been explored for other central banks, and my former colleagues at LSE Grantham have published a sectoral analysis of the corporate bonds purchase program by the ECB and the Bank of England, investigating the data until 2017, and they have found them to be skewed towards high carbon sectors, meaning the portfolio of corporate bonds by these two central banks was more carbon heavy than the economy in general, or the amount of available and eligible bonds. So yes, and the new corporate bond purchases have been implemented by the ECB and the BOE. Both of them scaled up their programs in response to the pandemic, and these have also been found to have a bias towards carbon intensive sectors. Yes, so this brings us to the empirical analysis, and I will hand over to Uli.
Yeah, thanks, Simon, and hello, everyone. So, as Simon said at the beginning, this is still very much work in progress. So these are by no means the final results that I'm going to present, but just some very preliminary results. And so what we are doing is basically examine the Bank of Japan's corporate asset portfolio. So here I will focus on the ETF purchases. So basically the stocks. We are still collecting the bond data. But we have a very comprehensive set now of data for stock purchases, and so the results I will show in a moment are all based on kind of the current purchases. but we also have actually historical time series, which we still have to analyze more thoroughly. So we're basically interested in what kind of assets is the Bank of Japan purchasing, and to what extent are these aligned with international climate targets. So we have the Paris Agreement, where obviously Japan is also party of, and so this sets out some very clear trajectories for reducing carbon emissions. Japan has recently, the government has recently declared its target to decarbonize its economy by 2050. So this is a backdrop against which we're looking at what the Bank of Japan is doing. Next slide, please. So the current analysis that I will present is based on the PACTA methodology developed by the Two Degrees Investment Initiative around Jakob Thome. And this PACTA tool basically helps us to measure the alignment of portfolios with climate scenarios across a set of key climate relevant sectors and technologies. And what it does is basically to match financial portfolios to asset level data that are drawn from different market intelligence databases. And it then uses these climate scenarios to assess whether the overall portfolios are in line with climate goals. We're going to look here at the ETF purchases, and in particular, we are going to look at climate relevant sectors, for which we have climate scenarios and asset level data. And these make up only around 10% of the BOJ's ETF portfolio, but they correspond to around 20 to 25% of market capitalization, around 3/4 of the total carbon emissions. Next slide, please. So in this one, you can see the BOJ's portfolio plotted against the topic, so that's the Tokyo Stock Price Index. And what we find is that the BOJ's portfolio has roughly the same relative exposure to climate relevant sectors as the topics. It's slightly less invested in fossil fuels and aviation and shipping, and a bit more in cement and steel, but it is pretty close to the topics. Next one. Here you have a breakdown of the power sector, where you have different components. So you have renewables, hydro are separately, nuclear, gas, and coal. And so again, the kind of this segment of the portfolio is pretty close to what you will find in the topics. The BOJ has slightly more renewables than the topics, but less hydropower, and coal, gas, and nuclear are more or less the same. Next one, please. So what's important is that basically this portfolio is not at all aligned with the Paris climate targets. For example, the projections for internal combustion engine production of the car companies included in the portfolio are stable. So whereas to be in line with Paris goals, they should be declining. And this is pretty much also in line with other indices such as S&P 500, which you also see. So sorry, the BOJ trajectory is the red line, and so the S&P 500 trajectory is the dashed line. But so bottom line is that the current car portfolio is not at all aligned with Paris. Next one, please. So there are some increases projected for electric car production, but it's not really in line with Paris. Next one, please. Yeah, next one. So here we have some snapshot from the power sector, where the oil production is expected to increase significantly over the next 5 years, which of course is not in line with the Paris goals. And this is actually much worse than even the S&P 500, which is the dashed line again, which is slowly decreasing. It's also not decreasing in line with the Paris Agreement, so it's kind of on a 2.0 to 2.7 trajectory, but still better than the BOJ portfolio, which is currently on a more than 3% trajectory in this respect. Next slide, please. Same with, or actually even worse with coal. So coal power capacity of the companies comprised in the BOJ's portfolio is projected to increase by about 20% by 2025, while obviously it should be decreasing. Again, it's doing much worse than the MSCI World Index, which is projected to drop by around 10%. So next one, please. Renewable power capacity among the companies in the portfolio should increase quite significantly, but what the Bank of Japan has in their portfolio is only a very mild increase. So again, it's very much off target, much more on a 3% trajectory, 3-degree trajectory. Next one. Skip that. Next one. So this is still a very incomplete picture, but what we can see is that, first of all, the BOJ's ETF portfolio is very close to that of the topics, which basically means that for the time being, the BOJ doesn't really take climate considerations into account at all, which is not really surprising because the BOJ has only very recently started to look into climate issues. But effectively, by tracking the topics, the BOJ is basically perpetuating the current high carbon exposure of both the Japanese economy and the Japanese financial system. And now, why should we care about this? There are two reasons. One is, and that's maybe the less important one, that by loading up on carbon intensive assets in its own portfolio, the Bank of Japan is exposing itself to stranded asset risk. Yeah? So the Bank of Japan is purchasing basically stocks of companies that are not at all in line with the climate goals, and this means high stranded asset risk. So the Bank of Japan is probably doing a pretty bad investment here. Now, the Bank of Japan won't go bankrupt. It can't go bankrupt, and so in that sense, we could say, well, it doesn't really matter. But of course, it is sending a signal to the rest of the economy, and more importantly, it is prepping up an outdated economic model. So arguably, it's sending the wrong signal, not least to the financial sector, where the Bank of Japan has itself started to emphasize transition risk as a material financial risk, a point that has been made very clear by the NGFS, the Central Bank Network for Greening the Financial System. It really ought to address climate risk in its own portfolio, in its own operations, to be in line with what it is preaching now. Next slide, please. So we are going to continue work on this. So as I mentioned, we are still finalizing the bond purchases, as we're going to include these. We're going to also look at historical trajectories for both bonds and ETFs. And we're going to employ other methodologies than the PACTA tool to also link to carbon intensity of the overall economy. With this, let me conclude, and looking forward to comments and questions.
Thank you very much. That was an interesting presentation. Now, we've had all the 5 paper presentations, and if you have any questions from the audience, please use the Q&A function at any time. Otherwise, I will sort of start by asking the panelists if you have any questions to each other.
I think the audience will want to use the chat function.
The chat function is fine. Chat function is good. Yeah.
Yes, rather than the Q&A.
Yeah. Now that I have you here, Tanweer, do you have any questions?
Yes, I do have several questions, but I'll ask my first question to Mimoza is, how would you characterize the mega banks, function in Latin America? I mean, on the whole, would you say it's playing a positive role or not, and based on your analysis?
That's a very interesting question, Tanweer. As I've shown from the numbers, from the data, what data shows is they do provide a key role in credit provision in the economy, and they support the corporate loans. They're like I said, in Mexico, for example, more than 80% of the corporate loans is provided by these foreign institutions. So in effect, recently, I would say it's positive, but at the same time, all of this profit is being repatriated back to their home economies. So, and my argument goes even further in the paper that green investment is also gone down. So it's hard to say whatever profitability they're bringing into the market is being drawn out of the economy as well. So I don't know, does that answer your question?
It does. I mean, I hear what you're saying, and so thank you for clarifying. I have a question for Yuli, if I may, Alexis. The following question, and your co-author, Simon, your co-author as well, is that since right now, I mean, the BOJ does not have a legal mandate or is not required to have a, in its QE or other asset purchase program, any kind of green mandate. So, and it has, so do you see that should be changed, or it should be in, if the objective is to promote purchase of green bonds or to increase purchase of green bonds, or who should be doing this? I mean, should it be the Ministry of Finance, to support green investment and green financing activity? Curious to know your thoughts on this.
Yeah, good question. So actually, Simon and I wrote a paper on central bank mandates and green finance, but that would be another one. So actually note that we did not mention the word green QE at all, because we are not promoting green QE here. So we're not saying the Bank of England, sorry, the Bank of Japan should be purchasing green bonds or what have you. It is basically around aligning their own portfolio with climate goals. And there are, broadly speaking, two reasons for that. First is, as I mentioned, if you stock up on high carbon assets, you are exposing yourself to stranded asset risk. So it is about fiduciary duty, if you like. You know, kind of, you want to be careful in what you purchase. You know, I mean, so you should avoid purchasing assets that are very at high risk of getting stranded. So that's the first point. As I mentioned, of course, the Bank of England, or sorry, thinking too much about the UK. The Bank of Japan, obviously, as any central bank, can't go bankrupt. So you could kind of wipe this off, but still, it does have an implication because it's sending the wrong signal to the rest of the financial markets. And so there is a very intensive discussion now in the central banking and supervisory community about aligning the financial sector with the Paris climate goals to avoid climate risk, to mitigate climate risk. So if the central bank is preaching this, then they should be practicing it as well. The other point is, and that's a kind of a broader discussion, and that's where kind of the issue of market neutrality comes in. You know, some would say, well, the central bank should be a neutral market participant, and they should not try to stimulate certain sectors of the economy or discourage others. Now, first of all, I would say that market neutrality is a kind of it's a fallacy. Yeah? So central banks are never neutral. Whatever central banks do, this will always have an impact on markets. I mean, whether they raise interest rates or lower interest rates, it always has an impact. But kind of on a broader level, it really raises the question on do we want central banks or other financial authorities to address structural problems in our economies? And climate change certainly exposes very grave structural problems. And I mean, do we want, as is happening now, the central bank to perpetuate the status quo? Or do we want the central bank to facilitate the transition? And this is indeed, at the end of the day, a political decision. I'd say it's less about mandates. I mean, regarding mandates, you know, central banks explicitly or implicitly always have a mandate to support macro financial stability. And this is very much an issue around macro financial stability. Whether we want them to support kind of structural change in government policies, you know, that's where we're getting a little bit more tricky. I'll stop here.
Thank you. Jan, did you raise your hand electronically? Or did you click on a button by mistake?
Yes, I did raise my hand electronic. I've actually got two questions. One for Lilian and you. I wonder whether you considered in your in looking at the banking system and the money market in Zambia, whether you looked at the degree of fragmentation of the banking market in Zambia, simply because it strikes me that if you have a highly fragmented system, as for example exists in the United States, you do get active use of the money market, you get actually much more active use of the money market than if you have a highly concentrated banking system, as for example in Canada, where as a result of the high degree of concentration, in effect the cash management is done much more internally within banks rather than between banks. So it's really to you and Lilian. To Uli and Simon, I do wonder about the essential idea behind greening, quantitative easing. My understanding is that quantitative easing is about supply and liquidity to the market. And if you do it on the kind of scale that banks have been doing it, I'm not sure that you can do anything other than essentially follow the assets that are available in the market. In effect, a large portfolio holder has to hold the market, or else moderate their purchases from the market. But if you want to, let's say, just to concentrate on green on green bonds, then you will find that there'll be very little. Either there'll be very few bonds available to buy, or in effect prices will change, and you'll in effect induce the carbon intensive sectors simply to greenwash their financing in much the same way that some of the oil companies are now doing.
Thank you. Lilian, do you want to say a few words about the banking structure in Zambia, because you're the expert, and sort of foreign banks, domestic banks, and sort of what are sort of the main features, and how do they might affect the money markets?
Yes, I think, thank you for that question. It's a good question. So in terms of the structure, we have like foreign banks and local banks. And they have like, mostly we have like the big banks trading amongst themselves, and then the small banks, more trading among themselves. So in terms of the structure, we also have it segmented. So we have about 18 banks, and then most of them are foreign banks. But the challenge that is there actually is that when you look at them in terms of sizes, they have trading relationships. So you find activities constrained because of these trading relationships. So we haven't really looked at that in this paper in particular, but that's another piece that would be interesting to delve on.
Thank you. And Simon and Uli?
Yeah, Uli?
I mean, Sami, go first if you like.
Yeah, maybe just a few points. I mean, what Jan mentioned is basically at the center of what motivated us to look into this. I mean, it of course gets very interesting when central banks are not just buying government bonds to support liquidity, but are buying other stuff. And for the ECB, it's corporate bonds, and so it is for the Bank of England, and for the BOJ, it's ETFs. And then it's interesting because, I mean, in the case of the ECB, it's well investigated, I think. It is interesting because it's based, as you said, on the market neutrality principle. But But what is interesting is that the ECB's corporate purchase program is biased towards carbon-intensive sectors. So it is buying more carbon-intensive assets than it should buy if it would correctly represent the market. So the market is less carbon-intensive than what the ECB is buying, and therefore what we want to discuss is it is basically around this principle of market neutrality and whether this is an appropriate principle to base a asset purchase program on. And with regard to the Bank of Japan, this ETF purchase, well, the Bank of Japan is only buying very few corporate bonds, and the ETF purchase program is based on the topics, or it's trying to mirror the topics. And as we found, it's only slightly more carbon intensive. But this is the interesting question. When central banks are trying to be market neutral, what does this mean in terms of carbon neutrality if the government is trying to achieve carbon neutrality by 2030, 2050? And the question is then, what does this mean for prices of these assets? What does this mean if a central bank is buying specifically more carbon intensive assets than the market then would be appropriate if it would want to represent the market. So this is exactly where it gets interesting for us. And this market neutrality principle is the question from which we start. And maybe Uli can chip in there.
Yeah, maybe just to re-emphasize that there is a big difference between green QE and non-dirty QE. Yeah. So there have been people who've been calling for green QE, so basically saying the central bank should purchase large-scale green bonds, yeah, and so favor this particular type of asset. I've always said that I don't think this is the right strategy. First of all, there simply are not enough green bonds. And secondly, there's no shortage of buyers for green bonds. Yeah? So indeed, there is a huge demand from the market for green bonds. Everyone wants to hold green bonds. So you don't need the central bank to stimulate this market anymore. Of course, they should also buy green bonds, but I would not advocate for a specific green bond market. And I would also agree that, at least in theory, QE, is a temporary policy. I mean, it's been rather permanent for a lot of central banks now. But kind of if the central bank, for monetary reasons, decides to unwind QE, and then it would dump all the green assets, and that would also then cause problems for the green bond market. I've been always very skeptical of green QE, but it's something very different if you look at climate risk in your portfolio and exclude certain high carbon, high risk assets. So on that ground, so basically on prudential grounds, I think there are very good reasons why central banks should stop purchasing carbon intensive assets. Again, this is, or if they do that, this would be sending important signals to the market, because it would tell market participants that companies that are not aligning themselves with the Paris goals, and indeed the government's climate goals, will not be propped up by the central bank. And that will have an effect.
Thank you. Can I throw in a technical question to you now that I have you here? So I don't know enough about the Japanese ETF market, but as far as I understand, the BOJ has sort of only bought ETFs that track topics and Nikkei. But there are other ETFs, of course, out there, those that track other indices that could be potentially sort of green indices. I mean, I don't know enough about the Japanese market, but so if they, for some reason, if they were allowed to buy other ETFs and sort of those that particularly focus on green energy or less sort of negative ones. Could that be sort of a way forward? Because that would obviously, with the size that they are buying, that could pretty quickly have an effect on those companies.
Absolutely, and it's a very good point. So we actually have a precedent in a way. So the government pension fund of Japan, which is the biggest pension fund in the world, a couple of years started a very clear strategy to align its portfolio with the climate goals, and so it has mandated basically all its so it doesn't do all these asset purchases itself. So it works through different investment companies, and so it has mandated all of them to follow certain rules regarding the climate target. So and this has been a big game changer in Japanese investment market. And as you say, the Bank of Japan, they're a big player. So if the Bank of Japan is basically, demanding new kinds of ETFs, it's going to change the game completely. And the important thing is, of course, it's all not black and white. It's not just kind of, or in this context, not green or dirty. So there's lots of shades of gray in between, but the central bank could mandate, or kind of could make clear only purchase certain types of assets if certain criteria, kind of ESG criteria, are followed. And for example, it could then also have a more activist approach and demand climate alignment from companies that purchase and so on. It could be a real game changer.
Okay, thank you. Any other questions from panelists? Otherwise, I have one immediately for Mimoza. One of the last slides you showed, sort of suggesting that carry trades in Latin America have sort of increased again, slightly post-COVID. Isn't that sort of, in a way, what we should expect after the turbulence in March? Central banks have sort of, well, especially the Federal Reserve, cut rates, sort of everybody is now back to 0%. Bond yields in sort of G10 countries are extremely low, which is normally an indicator that banks, whether you call them mega banks or multinational banks or something else, they immediately start to embark on carry trades again to sort of seek yield once all the turbulence is gone. And that was actually happened last spring. After that, of course, the bond markets have been fairly stable in major economies. What do you think?
I think you're right. There is still an opportunity there, but what I was trying to look at it from the implications of this. I mean, it's increasing, but I suspect it will be highly volatile. And what will happen in this high volatility period? I think that's crucial. That could have major implications for these mega banks or multinational banks, the markets per se. Because I mean, for the carry trade opportunities to actually exploit them properly, volatility, there's no room for volatility per se, right? But that's what that's why it's a watch out kind of phase. This is what I suspect. But yeah, there's definitely that search for yield in the Latin American markets.
Yeah.
Given the, yeah, definitely.
Yeah.
But we shall see.
And I have one question for Tanweer as well about the impact of the Bank of England repo rate on long-term yields, essentially. You were saying that the Bank of England repo rate is sort of the driving force behind gilt yields, essentially. What does it actually mean now that sort of lately, because you look at a very long time horizon, you go back almost 30 years. But if you, and I didn't have the time to sort of focus on every single graph, but what has happened, say, during the last 5 to 7 years when the Bank of England hasn't really changed rates much? I mean, they raised rates and then cut them after the Brexit referendum, and since then it's been pretty stable. Are you sort of suggesting that, yeah, sorry, are you suggesting that the Bank of England still has the power to steer gilt yields through the short-term interest rate?
Right. Well, I think it has. Yes, it does. I mean, both directly and indirectly. And also, what I would point out is that it's not so much. I mean, the direct effect of the policy rate itself, the overnight rate, is on the short-term rates on T-bills and so forth, which in turn affects the long-term interest rates. So it's indirect in that. And from day to day, there is fluctuations in short-term interest rates, maybe not necessarily because of policy rates, events and other drivers, inflation, news, expectations of policy changes and so forth, which in turn has an effect of long-term interest rates. So there is that. I mean, it's not. I wouldn't say that it's simply monetary policy and the repo or reverse repo rates that has the only driver of long-term interest rates, but it's one of the mechanisms. What I would say is that long-term interest rates have come down because short-term interest rates and policy rates are low as well. So that's overall the stylized factor is true. And I did not show this, and it's not in the paper, but if you look at shorter horizons, the relationship still holds, not as not as strong as it would be over the whole history.
Thank you, Tanweer. Any more questions? We sort of have maybe time for one more, just about. I can't see any hands and no electronic hands either. Okay, I just have to say thank you very much to everybody. I hear next year will be in Boston or online, but let's hope that it's going to be Boston so we can meet each other in person again. Yeah, thanks to everybody, and yeah, see you next time.
Thanks to everyone on the panel.
Yeah.
Thanks a lot, Alexis. Bye-bye,
Very,
everyone.
very nice to see you all. Very nice to see you.
Bye-bye.
Yeah.
Take care.
Bye.
Bye.
Bye.